So, chapter 4 continues what you've learned from chapter 3. So, again, in chapter 3, we've learned the beginnings of the accounting cycle, analyzing a transaction, um, putting the entry in the journal, posting that over to the ledger, and doing a trial balance. Um, Chapter 4 sort of picks up where that leaves off in a very, very important way. And so today we're going to be focusing on some basic accounting rules. You're learning, whether you realize it or not, you're learning the accrual basis of accounting because we are teaching you generally accepted accounting principles, how public corporations need to do their accounting. Um, and so we're going to get into a little bit of detail there. There's another way of doing accounting called the cash basis. That's legit. It's a legitimate way to do accounting. It's just that if you're a public corporation, you can't do it because it's not part of GAAP. We're also going to look at how we prepare for our final statements for the year, because the longest we can really kind of tell our owners whether we're profitable or not is 1 year. And so what happens after that year is we need to go through a process of closing our books, closing our accounting records for 1 year, and getting ready to have a new set of accounting records for the next year. And so we're going to learn about that. When we meet again, we will review all the accounting that we're going to need to be doing in terms of adjusting entries. And then the last objective is really the one that's the meatiest one. It's going to take us much of next week to get through. Okay. So first things first, we are learning about some accounting principles that are really, really important. You heard about them real briefly in chapter 2. One of them was called the periodicity assumption. And in the periodicity assumption, basically accountants divide up the economic life of a business into specific time periods. And that's important. That's important to know. We measure various things, specifically when you look at the income statement, right? The income statement is a measure of revenue and expenses, but we do it periodically. We do it for a period of a month. We also do it for a 3-month period, which we call a quarter. And the longest we will measure our income statement is 1 year. In other words, we will do income statements on a monthly basis. A 3-month period is called a quarter. And after a 12-month period, that's the year. That's the longest we can keep records. Okay. Because under the periodicity assumption, that's the longest period of time we measure accounting activity in an organization, which means at the end of that year, we're going to have to keep separate records. Now, what's a year in accounting? Now, remember the income statement, by the way, if I should remind you, along with the retained earnings statement, if you read the title of the income statement and the retained earnings statement, it'll tell you for the period of, right, for the month of this or for the year ending that. It tells you that it measures the period of time. It's subject to the periodicity assumption. Again, the shortest period will proclaim profit and loss is an income statement for a month, but no longer than a year. Question is, what's a year? Well, a lot of businesses simply use the calendar year, which you're very familiar with because we're so used to it in our life. It starts on January the 1st, right? And it goes through December 31st. At the end of December 31st, the very next day, January the 1st of the next year represents a new year. In other words, a new accounting period would also need to be, we'd have to keep the records separate from 1 year to another. And that makes sense. But not all businesses really need to report out. Remember, what are we reporting? The very first thing we're reporting is our profit and loss on our income statement. What's the revenue? What's the expenses? What's the net income, if any? It doesn't make sense to force every single business to report out every December 31st. In other words, doesn't we don't have to require businesses to use the calendar year to keep their accounting records. We can allow them to use any 12-month period, and that's called a fiscal year. Now, these 12 months have to be consecutive 12 months. You can't be skipping months. It's got to be a consecutive 12-month period. And businesses have the option to do that. Why would they do so? Well, let's take an example of, say, a dental office or a hospital. Dental offices and hospitals probably would use a calendar year. There's no particular time of that year in which they're exceptionally busy. They're not a seasonal business. They're open all the time, year round. And so there's no reason that they can't end their accounting year when the calendar year ends and report. However, when you look at other businesses such as retail or maybe seasonal hospitality industry businesses like seasonal hotels or say amusement parks here in the Northeast, it doesn't make any sense to wait, to use December 31st as the fiscal year. First with retail. In December, that's they're in the throes of Christmas shopping season. For most retailers, that's their entire year. And Christmas shopping season goes all the way into January. Usually after Christmas sales, which are still quite big, stores are still quite busy, go sometimes into mid January, sometimes a little bit later. And then after that, of course, everyone kind of disappears from the mall and the stores. So it's much better for a retail company to report their profit and loss. Remember, the income statement is the first statement, and it's the only statement that tells us profit and loss. It might be better for that income statement to not be done on December 31st, but be done on another day. So why can't they wait until, say, January 31st to report? Well, they can't, because they can use a fiscal year. But their fiscal year is going to be different than the calendar year in such as it's going to start February 1st of every year and end the following January 31st of every year. Okay, which is different than a calendar year, but still it's 12 consecutive months. Let's go to the entertainment and hospitality. So say you're just a seasonal motel and you're only open here in the Northeast when there's more tourists. And so you're basically a spring, summer, fall business. Okay. So let's say you usually close your hotel in October. Well, it might be best to report out your income statement, say by October 31st, so you'd know whether you had a profit or loss for a year. Well, if you're reporting out on October 31st, if that's the end of your year, you need to start your year November the 1st for accounting records. So November the 1st or October 31st would be your fiscal year. That would be the same for any business that might be seasonal. Even though they might only be open for several months a year, their fiscal period still has to be 1 year. Okay, they still have to keep accounting records year to year. All right, so that's important to know. And again, this matters because the very first statement we do is the income statement. Okay, so because we're doing the income statement, what are the two major accounts on the income statement? Revenue and expenses. So one of the principles in generally accepted accounting principles is a very important one called revenue recognition. And the revenue recognition principle requires companies to recognize revenue when the work was done or the good was delivered. In other words, if the performance happened, it's revenue. Right. And that is regardless whether they received cash that day for it or not. Okay. That's what the revenue recognition principle requires as part of GAAP. Okay. And this is what you are learning. That's different than another company who doesn't use GAAP or the accrual basis for accounting. And I'll tell you about that in a moment. So here's an illustration. See, we have a dry cleaner who cleaned clothes on June the 30th, but the customers aren't picking their clothes up until July. Well, according to the revenue recognition principle, the work was done on June the 30th, and so the revenue must be uh, shown on the books and recognized on June the 30th. And so you would have because they haven't paid for it, they would debit the accounts receivable and credit service revenue. The most important thing is to recognize the revenue on the day it was done. So this would actually be June 30th. So that's what revenue recognition principle is about. Even though it might not be until somewhere in mid-July, say the 7th or 8th of July, the customer shows up, picks up their dry cleaning their clothes, gives them the cash for it. Well, the cash is simply going to take care of their receivable. Remember, an accounts receivable is established when you've already done the work and you're waiting to receive payment for the work you've done. What does that mean? Receiving payment is you're waiting for the cash. So when you get cash from customers you've already done work for, it's because they owed you the money that you were waiting to receive that. So to be fair to expenses, there's an expense recognition principle as well. We have to match the expenses and the revenue in the same exact period of time. Again, periodicity assumption is big with the income statement. We have to match things when they happened. And so the expenses need to follow the revenues on all these statements as well. So welcome to the world of GAAP, Joint Accepted Accounting Principles. Look at what you've learned already. Understanding the periodicity assumption is critical because we have to divide our life into time periods. That affects a very, very, very important financial statement called the income statement, right? Revenues and expenses are on the income statement. The income statement's the only financial statement that tells us whether we had a profit or a loss. And we do so on a periodic basis, so it's subject to periodicity. And then, of course, the retained earnings statement tells us the story of that profit or loss. But I want to focus on the income statement because two very important things happen on the income statement. We report our revenue and we report our expenses. So the revenue recognition principle and the expense recognition principle, which are part of GAAP, part of the rules, say that all the revenue and all the expenses of that period need to be on the income statement for that period. No excuses. So how does that work? First of all, you are learning something called the accrual basis for accounting. This is why we have GAAP. These are the rules for accrual-based accounting. And again, accrual-based accounting, public corporations need to follow. So they have to follow the revenue recognition principle and they have to follow the expense recognition principle because GAAP requires us to use those rules for this type of accounting. That's different than something called the cash basis of accounting, which is a totally legit system. It's just that public corporations cannot use the cash basis, but all other businesses can. And a lot of businesses do. Most businesses do, in fact. So what is a cash basis? Well, a company isn't going to say they earned revenue until they get paid for it. Business is not going to recognize any expense until they actually pay the expense. And that's a big difference because it doesn't match things quite well. The cash basis is a little bit looser with when the numbers can be recognized. The accrual system is quite tight and shows, I think, a more accurate record of what happened. So here's an example. We have a company called Fresh Colors. That's just a very nice name for a company. And they paint a building, and they painted it in 2016. In 2016, they had a lot of expenses to paint that building, 50 grand. They billed the customer $80,000 to paint the building, but the customer doesn't pay them until 2017. Well, under the accrual basis, All of this happened in 2016 because they painted the large building in 2016. So the work was done in 2016. And so when the work is done, we recognize revenue. And of course, in 2016 is when they paid all these expenses. And so we recognize the expenses and match it with the revenue. So for the accrual basis, everything happened in 2016, and this was a $30,000 profit for this particular business. Nothing happened in 2017, even though, in terms of revenue and expenses, even though the customer didn't pay us until 2017. For the cash basis, they look at it totally different. They simply follow the cash. In 2016, they paid out. In other words, they forked out cash for all these expenses. And so they had all these expenses in 2016 because they paid the cash out in 2016. The customer didn't pay them the 80 grand until the next year, 2017. So that's when they recognized the revenue. Okay. So the accrual basis is what public corporations must go by, okay, in order to do their accounting records. The cash basis is open for everybody else. Okay. And again, I think the accrual basis is much tighter. I think this is a much truer story than what happened than the cash basis story was. When you read this story, I think matters more. Okay. Because everything did happen in 2016. If you look at the cash basis, you would think that, nothing really happened in 2016 for revenue, but they actually did work. They actually painted a building in 2016. They just don't show it until the next year when they get paid. So it's very interesting, but it's totally legit. And again, if you're a small business, you can use that. Public corporations, no, can't do it. Well, again, remember, before we can prepare our statements, we have to make sure all the revenue is there and all the expenses are there. And so that means we have to go through an adjustment process, which basically is a way accountants double check. They double check to make sure all the revenue is there in that period. They make sure that all the expenses are there in that period before they prepare those financial statements. Okay. So what we're going to be doing next time in Learning Objective 2, we're going to be learning about these adjusting entries called deferred adjusting entries or deferrals. And deferrals basically are assets that once we use them, we expense. Okay. So we bought a bunch of supplies. After we use those supplies, that becomes supplies expense. It also teaches us about unearned revenue, which is a liability. But once we do what the customer paid us to do, it's our revenue. It switches categories. So deferrals basically are the objective. Learning Objective 2 talks all about deferrals. And Learning Objective 3 talks all about the adjusting entries that we call accruals. And accruals are just the opposite. We recognize the revenue now, even though we're not going to get paid for it till later. And we recognize the expense now in this period, even though we won't pay it until later. So these are going to be the basis of our next class for adjusting entries. And then Learning Objective 4 in this particular book is where all the hard work is outside of the adjusting entry piece. Because all that stuff that goes on, every adjusting entry happens in the journal. And you know what happens? Anytime you put anything in the journal, it's going to travel to the ledger. And that means the balance is going to change. And that means that the trial balance needs to be done again. So everything that we end up doing is going to affect the trial balance. And we need to have something called an adjusted trial balance that you're going to learn how to do later in that particular chapter. And so that's the intro. As you see, it's basically, there's no accounting here. It's mere concepts and understanding that. So here they have the concept or term, and then on the other side, there's definitions. The accrual basis for accounting is basically companies keep track of things as they happen in the period that they happen. Versus the cash basis is they only record things when they get the cash or they pay the cash. So we definitely are learning. This entire book is on accrual-based accounting. Okay. The calendar year is clearly January 1st to December 31st versus a fiscal year, which could be any 12-month period. Periodicity assumption, right? That's what all this is about. We have to divide the economic life of a business into periods. The shortest period we measure is a month. The longest period we measure is a year. And we have to keep year-to-year records separate. And expense recognition, right? Basically, we're making sure that those expenses are matched with the revenues of that period, and we're good. So this introduces you to what we're going to be dealing with in chapter 4. Okay,